This Chapter 1 introduces the basic concepts behind counterparty credit risk, establishes definitions for a number of risk measures, and provides a couple of detailed illustrations for modeling and measuring these risks. The global volume of outstanding over-the-counter derivatives has increased dramatically over the last 2 decades. The exponential growth in the use of derivatives as risk management tools has been accompanied by a number of spectacular corporate and institutional failures, such as Enron, AIG, Lehman, and others, that were at least partly caused by the misuse of OTC derivatives. These, in turn, have put pressure on financial institutions to quantify counterparty credit risk more accurately and to set appropriate limits on this risk, in addition to raising the question whether institutions had been correctly pricing this risk in their dealings. Counterparty credit risk is the risk that a party to an OTC derivatives contract may default on his obligations under the contract prior to its termination, including in particular the payments required from him under the contract, causing losses to the other party. This risk is usually referred to as pre-settlement counterparty credit risk because the counterparty defaults prior to the final settlement of the transaction's cash flows. In contrast, settlement risk refers to the loss that would be realized if contractual payments are not received on the settlement date itself due to default on or right before that date. We focus in this module exclusively on counterparty risk under OTC derivatives, since exchange-traded derivatives are generally not exposed to this risk, the exchange essentially guaranteeing all cash flows between counterparties. Losses due to counterparty default are usually quantified in terms of the replacement cost of the defaulted derivative, including potential market impact of large and illiquid positions. Counterparty risk has 2 important characteristics that distinguish it from other traditional forms of credit risk. Uncertainty of exposure size is the first characteristic. Whereas under a loan or bond, the credit exposure is known at all times and equals the principal and accrued interest, credit exposure under a derivative is varied over time and depends on market conditions and fluctuations in the underlying risk factors. A bank has credit exposure to its counterparty only if the contract value is positive from the bank's perspective, since in such a case, a default by the counterparty would require the bank to replace the defaulted contract in the market with a new counterparty, which will require an upfront payment by the bank to the new counterparty. Conversely, if the contract value is negative from the bank's perspective when the counterparty defaults, the bank would owe money to the counterparty upon termination of the defaulted contract, so credit exposure would be 0. Counterparty risks are generally bilateral, with the exception of options, whose value is always positive for the holder and negative for the writer. The value of a derivative contract may be positive in either party's favor at any moment in time, So either party could face credit losses if the other were to default, depending on the value of the contract at the time of default. Counterparty credit risk is one component of the aggregate credit risk to a specific client. In most financial institutions, the credit officer approving counterparty risk limits for derivatives is also responsible for approving limits for all other credit exposures towards that counterparty. An efficient credit risk assessment depends on the ability to consolidate and measure accurately all these exposures, whether relating to loans, bonds, trade transactions, or derivatives, and spread over different geographies. Banks ideally require a system that enables them to aggregate all exposures to that counterparty, applying netting or credit mitigation agreements, and the management of collateral. Topics we will discuss in later chapters of this module. Once consolidated, these exposures are managed by the credit officer by monitoring limits against each counterparty with a view to limiting the maximum potential loss to the institution in case of default. The size of the credit line is based on extensive analysis of the counterparty's credit quality and its probability of default, taking into consideration collateral and credit mitigation agreements, and incorporating these into the institution's total credit appetite. Developing a sophisticated counterparty risk measurement, pricing, and management framework is very challenging. It requires a combination of systems integration, efficient simulation capacities, and good pricing functionalities that combine precision and speed. The complex stochastic nature of exposure profiles and the detailed modeling required for its measurement make Monte Carlo simulation ideally suited for this purpose. While exposure estimation helps the credit risk officer set and manage the credit limits, it is only one component of credit risk and needs to be consistently integrated into the credit pricing and capital allocation process, requiring an estimation of probabilities of default and migration, recovery rates, and correlations between credit events. Counterparty risk measurement and management has gained greater importance in the past few years and has been undergoing extensive change. Most market participants are attempting to reflect counterparty credit risk more efficiently in the pricing of OTC derivatives, and regulators are tightening capital requirements related to derivatives counterparty risk. This module, given the very nature of the subject, relies extensively on quantitative modeling. We have kept the quantitative angle as accessible as reasonably possible, without compromising necessary technicalities underlying the key concepts. We begin by defining a variety of measures commonly used in the quantification and management of credit exposure under a derivative contract. The labels we use may differ from one institution to another, so we define our terms carefully before proceeding. Counterparty exposure measures the potential losses that would result from a counterparty default and is usually quantified in terms of the replacement cost of the entire portfolio of outstanding derivative contracts, including the potential market impact of large and illiquid positions. Counterparty exposure is the larger of zero and the market value of the portfolio of derivative positions with that counterparty that would be lost if the counterparty defaulted, taking into consideration all enforceable netting or collateral agreements, but before adjusting for potential recoveries. Current exposure is the current value of the exposure to a counterparty. It equals the economic loss upon default that would be incurred on all outstanding transactions, essentially the cost of replacing or hedging the set of existing contracts if the counterparty defaulted at this moment in time. Potential future exposure measures the potential future changes in exposures over the contract's remaining tenor. This is particularly important for derivatives, whose values change substantially over time depending on changes in market factors. PFEs take into account the aging of the portfolio and the future movement of the underlying market factors that directly affect contract values. PFE is calculated for different future dates, starting with current exposure and adding the exposure resulting from future changes in relevant market factors up until the final maturity of existing trades with the counterparty. PFE is usually estimated via simulations, where for each potential scenario Sj of market factor movements, the value of the portfolio of trades with the counterparty is simulated up to the final maturity, and a PFE T curve is calculated for different future dates, T0, T1, all the way to Tn, with T0 denoting the present moment and capital T the measurement horizon, which is typically the longest maturity of any position. PFE can also be calculated for individual contracts in the portfolio, as we will show in a moment. Peak potential future exposure, or PPFE, is the largest exposure expected to occur on a designated future date, with a defined degree of statistical confidence, usually set close to 100%. For example, the 99% PPFE is the level of PFE that will be exceeded under only 1% of scenarios. The maximum PPFE over the life of the portfolio is referred to as maximum peak potential future exposure. PPFE and maximum PPFE are often compared with credit limits in the process of approving transactions. expected exposure, EE, is the average PFE on a designated future date. The curve for EET, as T varies over dates in the future, leads to the expected potential exposure profile. Expected exposures are computed using the same distribution of PFEs mentioned before. The EET curve is referred to as the credit equivalent or loan equivalent exposure curve and is used for credit pricing and for the calculation of economic capital for well-diversified portfolios of counterparties. Effective expected exposure, EE, was introduced by the Basel Committee and is the maximum of expected exposure at a given time or any prior date. It may also be defined recursively as the greater of the expected exposure at that date and the effective expected exposure at the previous date. As reflected in this equation. The various exposure measures are usually calculated by means of Monte Carlo simulation using the following steps. Step 1. Identify the set of market factors affecting the portfolio of transactions with each counterparty. This may include FX rates and yield curves in different currencies, commodity and equity prices, credit spreads, volatility curves for different market factors, and so on. Step 2. Define and calibrate the joint factor processes or probability distributions to be used in the simulations. The models must reflect present conditions and be flexible enough to account for plausible future events. Step 3. Identify a discrete set of simulation times from T0 to Tn. Step 4. Simulate from the underlying joint process a set of factor scenarios up to Tn, where I equals 1, 2, 3, all the way to m, and where typically m equals several thousand. Step 5. Evaluate for each simulated scenario and at different future times from T0 to Tn the value of each contract in the counterparty's portfolio. Step 6. Calculate the PFE for the portfolio taking into consideration all enforceable netting or collateral agreements, but without adjusting for potential recoveries. Finally, Step 7. Use the PFE values from Step 6 to calculate exposure measures. We apply the above to a simple example in this worksheet, individual swap, in which we contemplate a new counterparty wishing to enter a 5-year US dollar interest rate swap with a notional of $200 million, paying 6-month LIBOR and receiving 5% fixed, both semi-annually, and both calculated under an actual day count convention. The counterparty portfolio in this case includes just this one IRS transaction. We apply the Monte Carlo simulation steps described above to calculate the various exposure measures. Throughout this discussion, we assume that no collateral or other form of credit support is in place. The market factors affecting our portfolio are all contained in the US dollar yield curve out to 5 years. To simplify matters, and due to Excel capacity limitations, we assume that the yield curve is flat and moves only in parallel shifts up or down. This enables us to limit the number of factors to 1, being the future levels of the curve. The stochastic process we use to simulate future rates assumes that the percentage change in the level of rates is normally distributed with an annual mean of 0, usually called the drift, a volatility sigma of 15%, and time intervals of 1 month here. This can be represented mathematically as follows. Or alternatively, where ST is the rate level at time t, delta t is the time interval between now and the future rate level we are simulating, 1 month in this case, and z is a random variable that satisfies a standardized normal distribution, i.e. one with mean 0 and volatility 1. This can be generated easily in Excel via the function normsinvrand. We use a discrete set of simulation times spread at 1 month intervals from month 1 to month 60. Note that we have hidden columns K to Bj to preserve space. Starting from the current interest rate level appearing in cells C522 to C1021, and using the equation from just above, we now simulate future interest rate levels for the next 60 months in intervals of 1 month. To do this, we first generate random values from a standardized normal distribution using the normsinvrand function and copy them into cells D20 to BK519. This is done quite simply by typing into cell D20 the expression that you see in this rectangle equals normsinvrand with those parentheses in the right places, but without the quotation marks, which causes Excel to generate a number drawn randomly from a standardized normal distribution. And we then copy this same formula all the way down and across to cell BK519. Note again that we have hidden several hundred rows to preserve space. For this particular illustration, and to keep the size of the file at a manageable level, we have opted to generate 500 scenarios, but we could opt for a substantially higher number if we desired. The systems of many banks often use 10,000 scenarios or more. The future US dollar interest rates are generated by means of our equation for the simulation that we saw earlier, with, we remind you, a mu equal to 0, a sigma equal to 15%, and delta t equal to 0.0833. The 1-month interest rate is generated, as we have said, in these cells here, where, as you can see, we begin with the interest rate at 5% and apply the stochastic formula. The 2-month interest rates are generated in cells E522 to E1021, with each value once again starting with the 1-month interest rate simulated in the cell immediately to its left, hence the reference to D522, and applying to it again the stochastic formula. The same procedure is repeated for the 3-month interest rates, and so on until the 60th month interest rates in column BK. We now value the IRS from the bank's perspective, a positive value reflecting a profit and a negative value, a loss, for each simulated scenario from these rows here, and at each of the 60 different future instances in time, M1, M2, M3, all the way to M60. Since the client enters the IRS at current market rates, the initial value of the IRS is 0, as shown in these cells C1023 to C1522. Then in cell D1023, we calculate the future value of the IRS from the bank's perspective using the new yield curve that is now flat at 4.984, a number appearing in cell D522, and knowing that the remaining maturity is now 59 months. Recall also that rates are semi-annually compounded, and the actual day count convention applies. The formula is complex, so we spend a moment now guiding you through it. The value of the swap, denoted by V, J equals 1, TK equals 1 month, or simply V1 1 month, is calculated by means of the following equation, where LIBOR I is the LIBOR forward rate that resets at the beginning of period I. Since we have assumed that the curve is flat, all forward LIBORs are equal to 4.984% from cell D522. Note that for the first period, I equals 1, the LIBOR level has already been set at 5%, so the term to the right of the above equation equals 0. ZCI is the zero coupon rate used to discount the cash flow paid at the end of period I. Again, all zero coupon rates equal 4.984%, since we assumed that the curve is flat. Equation 1, shown above, can be rearranged as follows. The term we are now about to highlight allows us to calculate automatically how many full periods remain, 9 in the present case, as we move along row 1023. Thus, the first term in the right-hand side of our old equation 2, which we have reproduced here for your convenience, is simply the present value of an annuity paying the amount shown in the numerator of that first term over 9 periods and discounted at the semi-annual fixed interest rate appearing in cell D522. But we still need to further discount this amount for the 5 remaining months of the current period. Back in the formula, the term we are now about to highlight, starting here and all the way till pretty much the end of the formula, allows us to calculate automatically the time until the next reset in units of 6-month time periods, and works out, in this case, to 5/6, or 2 times 5/12, if you go ahead and make the substitutions. Therefore, the second term in the right-hand side of our old equation 2 is simply the 1 period discount factor, 1/1 plus half of the interest rate in D522, raised appropriately to the power equal to the expression that we had just highlighted. Starting in month 7, the last term in the right-hand side of equation 1 above, reproduced here for your convenience, is no longer 0. So we need to take it into consideration in the calculation. LIBOR 1 is the LIBOR rate that was fixed at the beginning of the current period and is paid at the end of the period, i.e. in 5 months, which corresponds to the term we used above to calculate the time until the next reset in units of 6-month time periods. The difference between this LIBOR level and the swap rate is discounted using the newly simulated interest rate level. To summarize the steps, for each scenario J and at each time step Tk, we calculate the number of complete periods of 6 months, N remaining, that remain until maturity. We calculate the next reset date T reset. And using the previous LIBOR reset, LIBOR Prev, and the newly simulated interest rate RJTK, we calculate the value of the swap from the bank's perspective as this somewhat intimidating expression here. We next calculate the PFE of the swap, starting on row 1524 to row 2023, via the equation we showed earlier and have reproduced here for your convenience on the right, with all terms exactly as defined before. We now use these PFE values to calculate the various exposure measures. Peak PFE is calculated on row 2025, beginning in cell C, as simply the 99th percentile of the PFEs appearing in the preceding table, and we can verify the formula, for example, by clicking on the first real month, month D, month 1, and seeing the percentile function. The maximum peak PFE appears on row 2027 and is calculated over the life of the swap. Expected exposure appears on row 2029 and is calculated simply as the arithmetical average PFE for each date in question. Effective expected exposure, finally, is calculated on row 2031 using the equation reproduced for your convenience on the right, this one here. Towards the right of the worksheet, we show a number of graphs. The top graph shows the future values of the IRS from the bank's perspective as calculated in rows 1023 to 1522. The range of values increases initially over time before peaking somewhere before the midpoint and then declining until the maturity date, as you can see from this nicely colored graph. And the same pattern appears in the middle graph a little further down, which shows the values calculated in rows 1524 to 2023 for the swap's PFE. Again, note peaking somewhere around or just before the middle and then declining until maturity. This pattern is even more apparent when we examine the peak PFE and the expected exposure measures in the final graph appearing at the bottom. This one here. The exposure, as you can see, increases initially and reaches its maximum level somewhere around month 24 before declining gradually until maturity. It is critical to understand what causes this pattern. Two main factors determine the credit exposure over time for an IRS, and these two factors influence exposure in opposite directions. Diffusion of the market factor, in this case the swap rate, and cash flow amortization. As time passes, the diffusion effect tends to increase the exposure, since interest rates have more time to diverge from their initial levels. The amortization effect, in contrast, decreases the exposure over time, since the passage of time reduces the remaining number of settlements under the IRS and hence the residual credit exposure. The diffusion effect dominates in the early years, while the amortization effect dominates in later years. The second pattern that is somewhat unique to swaps, including interest rate swaps, is the kink around each reset date. Exposure peaks on each reset date and declines the following day once the net settlement between the fixed and floating legs takes place, reducing the aggregate cash flows exposed to default. Finally, the occasional bends and twists, such as here and here, that appear every centimeter or two, are principally attributable to the small number of scenarios, 500, that we have used, and would disappear entirely if we used a substantially larger number of scenarios, such as 10,000, leading to a much smoother graph, except around the settlement dates, which would still reveal the kinks. Of the three graphs we show on this worksheet, this graph at the bottom is the one of greatest interest to the credit officer approving the transaction, especially the curves for peak PFE in blue and the one for maximum peak PFE here in brown. The credit officer uses this graph to understand the evolution of the credit exposure over time, the maximum peak PFE for the transaction, and when this maximum is reached. The transactor facing the client usually checks for credit availability within any pre-approved credit lines. If no availability exists, he will need the credit officer to approve a PFE line increase in the amount of the maximum PPFE over 5 years, or 18.6 million in our present case. Usually, if the credit officer agrees to the request, she will approve 18.6 million up to 2 years with a decreasing balance after that. In our next example on this worksheet, individual FX forward, we assume a new counterparty wants to enter an FX forward, buying 50 million euros against US dollars for settlement in 3 years. The counterparty portfolio with the bank includes just this one FX forward transaction. The euro-dollar spot rate is 1.4, and the 3-year dollar and euro zero coupon interest rates are 5% and 4% respectively. Based on these inputs, the 3-year euro-dollar forward rate, calculated in this cell C7, equals 1.4417. Again, we use the Monte Carlo simulation steps described earlier to calculate the exposure measures. The market factors affecting the counterparty portfolio in this instance are euro-dollar spot and the dollar and euro interest rate curves out to 3 years. Again, to simplify matters, we assume that both dollar and euro yield curves are flat and move only in parallel shifts up or down. This enables us to limit the number of factors to 3. The stochastic processes we use to simulate future values of the 3 market factors, euro-dollar spot, the US dollar interest rate, and the euro interest rate, assume that the percentage change of each market factor is normally distributed with an annual mean of mu and the volatility of sigma, and is represented mathematically through the following 3 equations. We set mu for dollar interest rates and for euro interest rates equal to 0, while mu for euro-dollar spot equals 1%, being the interest rate differential. Sigma for US dollar interest rates is 15%, 10% for euro interest rates, and 12% for euro-dollar spot. Delta T is the time step of 1 month in this case, so 0.0833 in all 3 cases. The Z's from the simulation are random variables that satisfy a standardized normal distribution, i.e. one with mean 0 and volatility 1, generated in Excel via norms inv rand. Alpha ij are new factors appearing up here in cells C21 to E23. For example, alpha 11 equals 1, alpha 1, 2 equals 0, but alpha 2, 1 equals 0.4. And these require a little explanation. These are necessary to ensure that percentage changes in risk factors are correlated in conformity with the correlation matrix appearing immediately above in cells C17 to E19. And they are calculated through what is known as a Cholesky decomposition of the correlation matrix, a name we mention but do not explain any further. Next, we use a discrete set of simulation times spread at 1-month intervals from month 1 to month 36. Note again that we have hidden columns J to AL to gain space. Now, starting from the current levels appearing in cell C 1535 to 2034 for US dollar interest rates, and using the equations from just a minute ago, we now simulate future US dollar interest rates for the next 36 months in intervals of 1 month along these rows here. We also do the same for euro interest rates along these rows here, and finally for euro dollar spot along these rows here. To do this, we first generate random values from a standardized normal distribution using Excel operator normsinvrand, as always. And we copy those random variables into cells D29 to AM 528, then into cells, a second set into cells D531 to AM 1030, and a third and final set of standardized normal distribution variables in these rows here, all exactly as before. And note that we have hidden once again several hundred rows to preserve space, and have once again opted for exactly 500 scenarios. The future levels for each market factor, as we pointed a minute ago, are generated for the next 36 months in these 3 sets of rows here. These for dollar interest rates, these for euro interest rates, and these for euro dollar spot. In a manner very similar to our previous example, but with the difference that the random terms are calculated using the alpha items up above in cell C21 to E23. Specifically, these obtained from the Cholesky decomposition. And each of the entries for Z1, Z2, and Z3 from the respective random value sets appearing here. For example, the random term for euro-dollar spot simulated in cell D2537 equals alpha 3,1 from cell C23 multiplied by Z1 from cell D29 plus alpha 3,2 from cell D23 multiplied by Z2 from cell D531 and plus alpha 3,3 from cell E23 multiplied by Z3 from cell D1033. We now value the FX forward position from the bank's perspective for each simulated scenario and at each of the 36 different future instances in time, M1, M2, etc., M36. Since the client enters the forward at current market rates, the initial value of the forward is 0, as shown in these cells here. Then in the remaining cells on the right, we calculate the value of the forward position from the bank's perspective for each instant in time, Tk, and for each scenario, J, using the new euro-dollar spot rate and the new US dollar and euro interest rates. This value is simply the present value of the notional amount of 50 million euros multiplied by the difference between the new forward rate and the forward rate at inception of 1.4417 from cell C7. The new FX forward rate, FJTK, is calculated using the usual formula, recalling that both interest rates are semi-annually compounded and that the actual day count convention applies. Here's the formula. We calculate the PFE for the FX forward on rows 3539 to 4038, these rows here, using our equation from before, reproduced for your convenience here on the right. All exactly as before. Again, we use these PFE values to calculate finally the various exposure measures. Peak PFE is calculated on row 4040 as the 99th percentile of the PFE appearing in the table above. And the maximum peak PFE over the life of the forward is calculated on row 4042. Then expected exposure is calculated on row 4044 as the average PFE for each future date. And finally, the effective expected exposure on row 4046 using the same equation as before, and again reproduced on the right for your convenience. To the right of the worksheet, a number of graphs appear again, with the top graph showing the future values of the FX forward contract from the bank's perspective. This graph here, as calculated on rows 3038 to 3537. This time, the range of values increases steadily with time and does not peak and then decline as it did in the case of the IRS. And the same pattern is visible in the middle graph showing PFE, and in the graph here at the bottom showing peak PFE and expected exposure. In all cases, the exposure measure increases as time passes and peaks at maturity. This is because the value of the forward contract depends on one single cash flow occurring at maturity, so it is driven solely by the diffusion effect. Again, the occasional bends and twists, such as this one here, are principally attributable to the small number of scenarios we are working with, 500, and would gradually disappear as we increase that number towards something like 10,000. This graph at the bottom is again the one of greatest interest to the credit officer approving the transaction. This credit officer will be asked to approve a PFE line of $27.9 million, i.e. the maximum peak PFE, and for up to 3 years. You are probably aware that banks embed an upfront profit when pricing a derivative transaction. This profit represents, in effect, the bank's initial credit exposure on the pricing date, since a default at any time by the counterparty would require the bank to replace the contract at market rates that would not contain this profit margin. This profit margin should therefore be factored into the exposure calculation when requesting the credit approval. For example, if the transactor has embedded a profit of $300,000 in the FX forward, he would ask for a credit line of $28.2 million. consisting of a current exposure of 300,000 and peak PFE of 27.9 million. Finally, there may be a time lag between the time the credit approval is obtained and the exact moment the counterparty transacts. So transactors often request a larger line to accommodate any sudden jump in volatility that could drive the PFE higher. Chapter 1 and Part 1 end here.